Adelante.
20% profit dividends included within 1 year. How do we came up with this number? Why should you invest in this company? Investing is all about finding good companies at good prices. A 20% profit dividends doesn't sound any bad. As Warren Buffett once said, the risk comes from not knowing what you're doing, but FEMSA know what they're doing. The company operates under 3 key segments. In the beverage industry by holding almost 48%, stake in Coca-Cola FEMSA. In the grocery retail industry by holding the 100% stake in FEMSA Comercio. And in the alcoholic industry by holding 20% stake in Heineken. It is a very strategic company. They intend to encourage the collaboration within subsidiaries and sharing of resources with all of them. Most of the main products sold by OXXO are carbonated drinks manufactured by Coca-Cola FEMSA, as well as beers manufactured by Heineken, who has also an agreement until 2020 to sell only its rights. FEMSA Comercio also owns other businesses that provides a range of logistics and vehicle maintenance to Coca-Cola FEMSA and third-party clients. We are very enthusiastic about FEMSA's recent expansion outside Latin American market through the acquisition of Coca-Cola Bottlers Philippines. It does not only provide an attractive growth potential outside Latin America, it also shows managers' awareness that Latin American market is becoming a little bit limited and somewhat riskier, while Asia seems promising for its beverage and also for its retail business, since traditional Filipino stores account for 99% and modern outlets just 1%. Heineken has a clear acquisition strategy. A clear acquisition strategy on getting more, getting an acquisition strategy of beer bottlers in emerging markets to increase market share. It's also, for China, it's recently focusing all of its efforts to increase market share in China, which is one of the countries they have with the highest levels of beer consumption. There are 3 main highlights for our recommendation. For FEMSA Comercio, we expect sales to increase 10% CAGR until 2019, while showing operational margins increase due to its recent incursion into the fast food service, going from its most current 5 to 7% during the same period. For Coca-Cola FEMSA, we expect sales to increase 7% CAGR, while showing operational margins around its current 15%. And for Heineken, we expect sales increase 3.5% CAGR and operational margins improvement due to cost reductions in Europe. Now Oscar will talk about financial analysis and valuation.
Thank you, Carlos. FEMSA has been able to maintain a negative cash conversion cycle of -18 days over the last 12 months. That means FEMSA doesn't need to pay its suppliers until they receive payment for selling those goods. Therefore, FEMSA can hold longer onto its money. Actually, this year, Coca-Cola FEMSA was awarded as the best managed company in Mexico and the 3rd in Latin America by Euromoney Institutional Investor. For profitability, we analyzed return on equity as well as return on invested capital. Last year, ROE dropped from 9 to 7%. This was mainly driven by a drop in net profit margin and lower asset turnover. However, our analysis indicates that ROE will fully recover and even increase by financial leverage and recovery in net profit margin. We believe ROE is the best indicator for performance analysis. Last year, ROE dropped from 8.4 to 7%. This was caused by the increase in debt, which in turn increased invested capital. However, we expect that ROE will remain around 7% for a forecasted period because we expect that Coca-Cola FEMSA will keep using debt for its acquisition. In order to forecast each subsidiary's income statement, we investigated the expected per capita consumption of bottled water, carbonates, and soft drinks for every country in which Coca-Cola FEMSA operates in, and along with its SQ prices, we computed its revenue. We did the exact same thing for beer consumption for the 71 countries in which Heineken operates. We use that information as well as market share per country to compute its revenue. For FEMSA Comercio, we use companies' expected number of new stores for the next 5 years, as well as average monthly transactions and average ticket per store, along with expected changes in market share. With this information, we computed FEMSA's revenue and came out with a 9.6% consolidated for our forecasted period. Our growth estimate for FEMSA requires financing, and as it is management willingness to maintain its net debt to EBITDA below 2 in order to keep its current debt ratings, we limited our expansion to these levels. Our cost estimates are based on our analysis of future markets as well as companies' expectations for the future prices of its raw materials. The result was an average of 57% cost as a percentage of revenue for our forecasted period. Although we made a relative valuation comparison, we believe it's not the best way to compare FEMSA's value because not many companies have FEMSA's business model. We believe free cash flow to the firm is the right approach to value this company. Using our estimates and a sensitivity analysis, we came up with 140 pesos as target price. For the sensitivity analysis, we computed a Monte Carlo simulation with the 3 key drivers for our valuation: WACC, terminal growth rates, and EBIT margin. From this simulation, we concluded that we have a 31% probability of incurring in a loss and a 47% probability of getting at least 20% total shareholders return. Now, we will be talking about risks and conclusions.
Is FEMSA a risky company? We don't read it at all. I just want to mention the main risk in its 3 divisions, starting with FEMSA Commercial. Cannibalization between OXXO stores could lead to reduce the same-store sales. However, OXXO has a moderate penetration in the northern part of Mexico, an average of 10,000 people per store. So, we expect them to open most of the future stores in the south and central part of Mexico, where they have an average of 50,000 people per store. Grocery retailers such as 7-Eleven could affect OXXO revenue. However, OXXO has the largest number of stores in Mexico. There are 7-Eleven per every OXXO in Mexico. In Coca-Cola FEMSA, the effect of currency fluctuations has been very real in the past. There was a loss of 3.5% of operating income in 2013 as a consequence of this issue. Therefore, we estimate a loss of 2.8% for the forecasted period, mostly for the continued depreciation of the Argentina peso against the Mexican peso. Exposure to Venezuela and Argentina, about 27% of total revenues in 2013, comes from these 2 countries. Also, Venezuela has experienced a lot of new regulation, like labor law, import of raw materials, and currency changes. Yet, Venezuela happens to be the country with the highest growth in 2015, about 90% net revenue. The current trend of healthy living backed up by the government taxation may affect margins as well. But we think Coca-Cola Company is actually taking the necessary measures to adapt its portfolio to less caloric drinks, such as Coca-Cola Light that just entered the Mexican market. In Heineken, its exposure to Western Europe and the slow economic growth in that zone could affect margins and revenue as well. We expect but Heineken reported a cost of savings in 2013 about 2%, mostly or driven by fixed cost reduction in the supply chain. His exposure to forex volatility and alcohol regulation could affect margins and revenue as well. We initiated a coverage in FEMSA with a 140 pesos as a target price by December 2015, and a buy recommendation that implies 21.5% with dividends included. This is a great moment to invest in this well-managed company. His managed capabilities and strategic audience give room to shareholders to value creation. Also, our recommendation refers for 1 year holding period. We recommend this stock for the long run. Thank you very much.
Of the event, and this is the third time that I can participate as a judge. And what we can say is this event has improved every year. The quality of the papers that you send and the quality of the presentation in general is really improved. So congratulations for all the teams. And now, my first question is about the valuation. Why you don't use another valuation method, the sum of the parts? Why did you decide to use this evaluation and not, once again, the sum of the part valuation with a company like this one, who has a different sectors participation? I know that it's not easy to make a valuation using multiples, but what about the sum of parts? I would like to see your opinion about this.
So you want to know why we use...
Why you don't use the sum? Why do you consider that using the sum of parts was not the right valuation for this company?
We actually forecasted each subsidiary's income statement as well as balance sheets. What we believe is not a relative way to measure it is with multiples, because as a whole, FEMSA has its own ecosystem of sharing of resources between subsidiaries. So estimating free cash flow to the firm for each of its subsidiaries, it's the best way to measure its value, because it's intrinsic and is not affected by industry trends.
First of all, you guys did a good job of keeping your train of thought given the construction of the next door, so good job there. I'm curious, when you were talking about valuation on the upper end of your band, you had up to 40% upside. I'm curious, what do you think that you guys have discovered that the market and other investors have not? Where do you think the biggest difference is, the biggest delta is between your opinion and what the market is seeing?
It's actually 21%.
Yeah, I'm sorry, I think you did a valuation band earlier.
140 pesos is the target
I
price.
think there was a 20% chance that it could go up. Oh, sorry, I read it wrong, the shareholder. Okay.
Yeah.
Sorry. So what do you think why do you think the market is wrong on your, why do you think there's so much upside in the company?
Particularly, the time when they did our valuation, the stock trades at 118. Now the stock trades about 132. Maybe from now to today it will be upside about 8% or something. But when we close our job, we take the price something like October 17th, and the price was this one.
Right. No, I'm sorry. The question. So if there's 20% upside, usually the market's fairly efficient. So what do you think the market? What do you think the investors were missing when there was 20% upside?
Well, we don't believe it was like mismatching. I mean, when we did the first valuation, we came up with a 140 price as target price, and the market has actually recovered from its 180 to 133. So our valuation is based on future cash flows to December of 2015. So that's when the upside comes. Thank you. 1 year.
Yes.
Well, my question is about the multiple valuation analysis. You decided to drop this methodology from your investment recommendation, and the question is, this is because you arrive at different multiples for other companies, and then you decided, well, this doesn't fit with the multiple of FEMSA, and or you first not considering the multiple analysis, and you just presented some comparison here. So the question is, because of the data, you decided to put aside the multiple valuation analysis, or was an original idea from you to not include multiple valuation comparisons into your valuation model?
Okay, thank you for the question. We believe, as FEMSA has a very strategic alliance between subsidiaries, not many companies share this ecosystem between enterprises. So as FEMSA Comercio doesn't trade in the market by itself, it's hard to compare pricing multiples. So what we could do was to compare Coca-Cola FEMSA, which it's actually a trade company by itself, and also Heineken. But Heineken, FEMSA as a whole is not easy to compare to its peers. So when we made it, we believe it's not very important or significant.
And it's a little bit harder too, because the part of OXXO, it doesn't are public, which is we decide that.
So did we answer?
Given that FEMSA just have a seat on the board of Heineken, but it's not they don't have voting rights, would it be better for them, or what kind of synergies do you see between FEMSA and Heineken? If you compare the market value of FEMSA and Heineken, they're almost the same, they have the same value in market cap. Would it be more efficient for them to sell their position in FEMSA, in Heineken, and invest the money in some other business that will make more sense to the synergies of the logistics of FEMSA? What would you think about that?
The effect of this merger is the diversification of risk could be too, because Heineken operates in 70 countries, and could be an opportunity to FEMSA to use its strategic audience and replicates their model in other countries like Philippines or like Colombia or something.
And also, let's not forget what the value of FEMSA comes from. It's a very strategic company. Also has an exclusive agreement with Heineken to sell only its brands until 2020. That agreement came after the acquisition, after the merger with Cervecería Montezuma and Heineken. So
We also believe that in this case, Heineken, the diversification, for example, FEMSA Comercio, most of its business is about carbonated drinks, and we all know that that market or that business is going down because of the more regulations worldwide on those kind of products, and the diversification and having another market in the beer industry could make things go in a better way.
Good afternoon. Congratulations. Do you believe that the company could be effective in the future for the reforms? What would be the risks?
We believe that in this particular case of carbonated drinks, most of our the scenario that we saw during this evaluation was that the clients had to adapt to the new taxation. It also affected a little bit. It also affected the business, but we truly believe that it is more focused on the customers, and the customers had to adapt to that raise on the taxation.
in their latest conference call, they talked about the effect of taxation in carbonated drinks. Although the tax increase is trying to reduce consumer of these products, Coca-Cola FEMSA reported a 6% organic growth year over year. Also, we are expecting a downtrend for the carbonated drinks. Now they represent 48% of total Coca-Cola FEMSA revenue, and we expect that until 2019 2019, they will represent only 79% of total revenue.
Okay, time. Thank you very much, guys. And the next theme is la autónoma de Nuevo